To Mortgage Talk with Mark, where every week we bring in some very interesting people on different subjects. And today I'm going to introduce you to a new friend of mine. Matter of fact, shout out to Scotty Campbell for the introduction to Justin in the last name again.
Justin Hubert.
Hubert.
Yeah,
I knew it was along those lines, and we'd actually met in the past.
We have,
and so we reconnected, and I've heard a lot of good things about you personally and about your company. You own Park Place Finance, is that?
Yeah, Park Place. We're a private lender out of Austin.
Yeah, introduce yourself, Justin. Sorry about that.
Yeah, appreciate it. Appreciate you having me on. I've been listening to your podcast for a while, and amazing guests you've had on here. I'll try to hopefully add some value compared to them.
Absolutely.
So, yeah, but Scotty, shout out to him. Appreciate the introduction and having us on here. But yeah, we're a private lender out of Austin here, but we lend nationwide on kind of 4-family, fix and flips, ground up construction. Could be a single family house or a subdivision, anything investment property in the single family to 4 to 5 unit is kind of what we lend on. Small multifamily as well.
Awesome. And as you know, I've been in the mortgage space for 40. Well, you may not know that, but for 40 years.
I know for a while.
Yeah. As you can tell by the gray hair, but I'm in the more traditional finance, Fannie Mae, FHA, VA, et cetera. Would you have some background on that too? So what I'm excited for me, even personally, is to learn more about what you do. So maybe we can do some business together. Okay. And you work in a field of lending, which is outside my box. I'm more traditional, if you will, but the term we use is hard money. Is that correct?
Yeah, it's funny, Mark, is everybody has like a different connotation of hard money,
Right.
It's like, oh, if you don't pay, like there goes the kneecaps, right? So I always joke, we stopped that with COVID, right? We took away the kneecaps. Yeah. No, so,
hard kinder, gentler.
Yeah, a little bit gentler now. Now we just, beg you to pay. But yeah, so no, but the interesting part is like hard money has so many connotations. It could be, commercial or residential, or hey, I just need money. What we really focus on is single family to 4 units investment properties. They could be in all sorts of conditions. So that could be in like a great condition, but you got to close in like 12 hours, right?
Is that quick?
It's very quick, right?
Wow.
Quick turn times. Now we need title to play ball. We need the borrower to play ball.
Sure.
You got to be proactive. So, but we've closed.
But it's not like coming to me and it takes 30 days.
Right. Yeah. We eliminate the bureaucracy. We don't look at tax returns. I don't really care a whole lot more than like, is that property worth what you think it's worth? And at the end of the day, like our ultimate goal is to make our clients money. Like they go in and build and flip a house, let's just say here in Austin. And we want to make sure they actually make money on that. And so what we do is we're the financing, and we can lend, up to 95% of the purchase, 100% of the rehab. Most of them end up anywhere from like 80 to 90% of the purchase, 100% of the rehab.
That's amazing.
And then we look at what's called an after repair value, which is just the value of the house after you've done the repairs.
Sure.
And we have a limitation there, somewhere 70, 75%, depending on your experience. So we kind of, in lieu of what would be normally on a conventional loan where you take into account DTI, credit score, we supplement that with your experience. So that's what causes the differences in leverages or down payments.
Okay. So, but to be clear, your perfect client, if you will, is an investor. You don't deal with people buying a home to live in. No homestead lending. Correct?
Great question. Yeah, no homestead living. So we're really talking only today about investment properties. But it's a huge market. It's roughly $152 billion market.
Wow.
That are fix and flipping or ground up construction.
You're talking about around the country?
Around the country. Yeah. Yes, sir. And so, and Texas is like the second or third largest state. California being the number 1, and Florida being number 2. And Texas slides right behind Florida. So there's a huge market here for those that might be first-time investors or those that are flipping houses currently. We have a ton of market data we'd love to share with anybody to show what is successful, what's not successful, and more importantly, how you can make money in flipping houses.
Sure. Is that your main product, fix and flip?
Well,
would you say
it's kind of the
tell us about your product mix or type of product or type of end user.
Yeah, you bet. So there's really 4 key products that we have. So you have a house, let's just say it's an investment property and it's completely done, and you just need to get it closed quickly so you can, put some furnishings in, and maybe you're going to Airbnb it, right? And maybe because you switched jobs last year, or you just didn't have the income because you're self-employed that actually you declared on tax returns, you don't qualify for any traditional lending. So we could just do a bridge loan based on the value of the house and a certain LTV, based on where the location is and the quality of the condition of the house, and close on that in, like, again, a day or two, right?
That's amazing.
It's a 12-month loan. There's no prepayment penalty. Then we kind of go down to, hey, this house needs a little bit of work, which could be a fix and flip, or you might want to hold it after you're done with it and rent it out. And so those we call that a kind of your fix and flip or fix and hold loan, where we can finance 80, 90% of the purchase, 100% of the rehab. And we don't really care what the condition is today. We care about what you're going to make it in the future.
Got it.
And then the third loan is just a ground up construction. So there's a lot, or maybe there's a tear down. You want to build that house. Or it could be a subdivision of 10, 20, 30 unit houses. And we can provide either horizontal and the vertical infrastructure to go in there and build the house and build the subdivision out as well. And then that fourth product is, hey, the product's done. The house is built. I'm renting it out, and I want to do a long-term rental on it. Or maybe you want to Airbnb it or short-term rent it. And we have a 30-year fixed product that's, very competitive and comparative to the conventional loans, in the mid sixes today on rates on 30-year fixed.
Well, with that kind of flexibility, I can see why you're nationwide, man.
Yeah,
you're a big dog.
I don't know about that. We're trying to be a big dog, right? So we're trying to be the next Mark, right? So,
that's kind.
Yeah,
that's kind.
Yeah.
And you've been in this space 10 years? You said 15 years?
Yeah. So I started Park Place in 2006, and we did
20 years.
Conventional lending. Yeah. So back when you were probably in diapers. Yeah. I'm probably a little bit older than you.
I think so.
You got the better looking hairline here. So, but yeah. So we started in 2006. So we did the Fannie Freddie loans and conventional loans, and then 2019 kind of outgrew that a little bit and went to this private lending. And I thought, like, who wants loans at these kind of higher rate loans, for short duration. And at that time, we'd done about 14,000 loans of connections we had in our database. So we sent out to
14,000.
Yeah, people we had in our database, right? And so we sent that out to about 1,000. I said, hey, we have this product if you have any interest. It was just crazy how much that went gangbusters. Like, yeah, I have this house. It's just not going to qualify for any bank loan because of the quality and condition. And so it kind of grew one loan a month to, 100, 150 loans a month that we do now. So,
wow, that's amazing.
Yeah. We work with a lot of loan officers, work with a lot of realtors, a lot of referral partners.
Yeah.
And, the biggest thing we want to do is sure, we want to make sure we can provide a quality loan, but more importantly, we want to look out for the client and make sure we feel like they can make money on the product.
Well, because they'll come back.
Yeah,
you got repeat business,
Mm-hmm.
because investors like to buy more property.
That's true.
Let's face it,
Yeah.
And you can also, I assume you can also do a refinance of a property. If somebody has a property, let's say free and clear, and they need some cash, they want to go buy something, you can help them with that.
Great question. Yeah, absolutely. So we can help them out with, anything from, hey, I need a little bit of cash. Maybe they have it listed for sale, like a builder that's just got some excess inventory.
Yeah.
And they just can't get it sold. Well, we can give you a little bit of runway. We can roll in payments. We can get very creative. It's it's kind of a la carte type of loan. So there's not a one size fits all. So we work with first time builders. So if somebody's like even thinking about building a first time house, there's some caveats and some restrictions more than your institutional grade builder.
Right.
But we really work with small to mid sized builders, small to mid sized flippers, anybody that's building or renovating or just needs a rental property to close quickly. And these are, again, quick close loans, 12 to 24 month loans. Yeah.
So let me back up for a minute, because when I take an application for someone, so they're buying a house, we do a conventional loan for them to buy a property. We have to send that package to an underwriter, and they take a couple of days and look it over, and they say, oh, we like this deal. Who underwrites your product? You?
Yeah. So,
how's it? Is there a committee? What do you do?
Well, we spin a wheel, and on Thursdays it's me. Sometimes there's a couple others. Yeah.
Draw straws.
Yeah, draw straws. And if you have to underwrite, then we buy you lunch or something. No,
right.
We have everything in house, so that that's the nice part about this. This is all.
You don't got to get a secondary approval for anybody else. It's your decision.
Yeah. So I own a portion of the company. A private equity firm owns a portion of the company. Yeah, we just really, make common sense lending decisions. And that's the beautiful part about the speed, right? Like, with doing, I don't know, 10,000 of these or whatever we've done so far, being able to make sure that, like, hey, we have the experience to know whether that's going to make you money or not. And that's really our ultimate goal, because we can provide a tool to make, say, generational wealth on a rental property, or passive income on a cash flow basis. I mean, that's really our ultimate goal, is to help empower families, empower individuals to be able to make sustainable income off of real estate.
Now, you obviously live in the Central Texas area, and you have for a long time, I assume.
Yep.
So and markets are different from state to state, area to area. Is underwriting these type of loans change much if you go to, mentioned Atlanta earlier before the show as being a hot market, or Florida, maybe in California. Does that change at all on how you decide to loan out there?
Yeah, so I'm a nerd and a geek for real estate data, and so we look at that constantly and make decisions based on that, because you kind of go back to the concept of, we want to make you money, and if that house was worth, say, $100,000 today, but in historically in that zip code it's losing 10%, then common sense would just tell you that it's worth 90,000 a year from today. Right. And so we have to take that into account for sure. And we go really into the micro markets. We don't look at Austin as a whole. We look at it by zip code, and sometimes even loan sizes within zip codes. And so, like, first example, like the 78745 zip code historically has been a amazing area for flippers.
Home run. Right.
Yeah. Home run.
Right.
Not even a double. It's like a home run. And so we want to make sure we take a higher risk on that, because we know the chances of success in the client making money on that is higher. If we go in a certain area that maybe is a little bit depressed, it could be things beyond the housing market that are causing that. Maybe it's oil prices going up or down, or a tech industry coming or going across country. Then that plays a little bit of different factors into what our lending appetite is in that area.
Yeah, because everything's always changed. In Austin has been depressed a little bit in the last couple of years, and I have some friends who have lost, quite a bit of money because they timing was off, so a lot of it is around timing. That could be a downside, but it's a downside anyway.
Yeah. And you hit the nail on the head there, Mark. And for our side, it goes down to how long are you going to be in the property, which comes down to how much renovation do you need, right? If you're going to go get permits in Austin, even in today's a little bit of express market versus, say, 2 or 3 years ago, where it was maybe a year and a half, some of those permits are still taking 6 months or 12 months. And so that means you're going to be in that property longer, which means you are a little bit more exposed to what that market might be down the road. So we take that into account for sure. Yeah.
Now let's talk about the cost, because some of the but stigma around hard money is the fees, because it's underwritten different than my loans are, So talk about a little bit about the fees and costs. Get people prepared for that. They want to call you.
So we're roughly 2 to 3% above market rates of bank rates. So
I thought it was higher than that.
Yeah. So we kind of move with the market, just like everything. Our funds are backed by retail investors. Some of us, people that invested $100,000 into our fund, and others are institutional with considerably more than that. And so our cost of funds really kind of moves with SOFR or with the trailing treasury bills, et cetera. So, and there's a markup with it, just like any other bank loan or et cetera. Right. But we're roughly 2 to 3, 3.5% above where the bank rate was. So if you were getting a loan today at, say, 7.5 on a construction loan, we'd be closer to 3% above.
Yeah. 10%, something like that.
Give or take. Yeah. But when you take that into account, and sometimes people get too caught up in the pennies to, and don't look at the dollars. If you don't have to close on a loan and wait on the tax returns, you don't have to go through this kind of root canal sometimes that are with the banks, with the approval process. You close in 2 or 3 days, especially like a time like now where we're kind of starting 2026. And that means you could start that project this week or next, whereas a bank loan might be started in mid or late February.
Sure.
That's a huge difference of getting it back on the market in the prime time of the season. And so, and keep in mind, you might be making 1 to 12 payments on this thing. So,
Right.
yeah, rate's somewhat irrelevant.
Somewhat
in the overall
irrelevant.
equation.
It's not long term like my loans are typically.
Yeah. And then what we want to do is, give them back to somebody like yourself that's very experienced, very knowledgeable in the space, and those are more long-term duration loans. That maybe
people can refinance out of your hard money loan, if you will, and do a more traditional loan down the road.
Yes, sir.
If they choose to.
Yeah, and that's where the rate really matters, right? Like, in any real construction loan, if you use the project right, it doesn't matter as much on the rate. I mean, it's not to say it's not important; it does, but it's more pennies than dollars.
Yeah, not like any portfolio of loans, even Fannie Mae loans, FHA, loans. There's a certain percent of those that go into foreclosure. The bank has to take back. Tell us some of the biggest mistakes maybe people have made that you've seen that people want to make sure they avoid, lessons learned, if you will. Can you share some of that?
Yeah. The biggest mistake is not thinking through the whole exit strategy in the project. It's ready, fire, aim, right? Instead of, let's aim where we're shooting. And so that's a big part. We try to help and coach that along the way, with doing almost 10,000 of these now. We want to make sure we coach you along the way. We're not a loan to own company. We have very low defaults for a reason. We want to make sure you're successful in this. Yeah,
don't want that.
No, we don't want that. Yeah. So and that goes back to the connotation to hard money. Like, they're lending money with the intention for us to take the property or them to take the property back, and that's just not factually inaccurate. Nobody wants that. No. Yeah. And so we want to make sure you're successful with that. And so we look at some of those details there. But one of the mistakes that a lot of people make is just not putting in contingencies. And so we make sure, hey, we need to think through some contingencies. Any great builder out there, and there's a lot of great ones out there, especially in Austin, that we work with, and they all have contingencies. Things pop up that just unexpected, right? Whose line needs to be moved 10 feet. Having room for that contingency in the budget, in the construction budget, or if it's flip, is important. And then also today's market, like, you might be on the market a little bit longer than what it was in 22, right?
Sure.
Like, you had multiple offers by the time, you put
the
sign down in the yard, there's 10 offers, and today you're waiting a little bit.
Yeah. So getting back to the markets around the country, I didn't realize until today when we met talking this day that you're nationwide. And so and obviously you're a guy who likes to look at numbers and trends and that sort of thing, So what's a little inside scoop on where should we invest our money right now?
Well, I get that question asked all the time. I promise if I had a one-word answer. Yeah, exactly. But look, certain areas in Austin are still very hot, but it is all in the buy, right? And we have roughly 90 employees, and they're spread out across the country. And so, California is always hot. Florida is hot, but you have to take into account what the cost of insurance is there now with some of the hurricanes and things that are popping up there. So that plays a little bit of factor if you're thinking about a rental. If you're thinking about rental income, then the one thing about Texas is the high property taxes, right? Great, no state income tax, but you have some higher.
That's right.
State
and insurance too.
And
insurance costs are going up. Not like Florida, but
and so and then I also say, like, not all markets are exactly the same, right? If I said in Austin, that's a holistic approach, and it goes down to are you trying to flip the property? You're trying to make this an Airbnb, and then what is the purchase price? How many bedrooms do you have? Well, what's the exit strategy? Like, who's your intended buyer on the other side, right? If you have a condo in downtown Austin that you renovated and it looks magnificent, your target end buyer is not the same person that's got a 4-bedroom in Circle C, right? So we need to you need to be aware of what that exit strategy is and who is that end buyer as well when you're doing that. And that goes with any real estate. And we have so many great realtors in the area that I know you work with as well. And they can help as well. I mean, while we are the financial aspect of the equation and the transaction, we also try to look out for the holistic approach for the client.
Well, before I forget, I want to make sure people know how to get a hold of you. They want to talk to you directly or they have a situation. Is that okay?
Yeah. So you can just call us. It's 512 loans. That's again 512-505.
I like that.
6267. Or you can reach out parkplacefinance.com. We have all of our program matrices on there. And soon we'll have an engine where clients can actually go on there and actually price their loans on there. So we should have that in the next few weeks where you can say, hey, does this loan qualify? And we'll go down to the actual zip code. So
that's cool.
Yeah. So that'd be nice
cool
to kind of talk through that. And it'll have a profit matrices say, hey, how much, if I did this loan, like how much money, do I think I can make off this if I flipped it or I built this house?
Yeah.
And so we want to give a lot of tools there to be successful, but contact information again, 512-505-6267. Or you go Park Place Finance.
You have an office here in town?
We do. Yeah. We're just off of Mopac here. So,
nice.
Yeah.
Nice.
So,
That's very cool.
Yeah.
Now here's another question that I just popped in my brain, because I've done some rehab of properties, and we've rehabbed our own house in Lakeway that we live in currently. But it seems to me that hiring the right trades is real important. Do you recommend people when it comes to that sort of thing? Just curious.
Yeah. So two things. We have a trade list we can provide depending on certain areas. We do loans in all across the country. So we have trades across the country. We work with a lot of flippers that flip, 4, 5, 15 houses a year. And so, they have tradesmen that they've kind of referred to us that we can share as well to other people. So happy to do that. If you're a tradesman out there, you want to get on our list, we'll kind of go through a little bit of a vetting process, and we're happy to add you to that list too. Yeah. So please reach out to us. Just call me at the number again, 512-505-6267, or Justin at parkplaceus.com. And
that's good to know.
Yeah, we want to help small businesses, right? And so whether that be a tradesman or a trade company, or like a roofer or a plumber or electrician, or people want to flip houses, our goal is to make them successful financially.
Yeah, well, that's good. That's good. And there was another question that popped in my head. Now I can't think of it. What else can we talk about? Because there's certain, I don't know what I don't know.
Mm-hmm.
Let me ask you this question, because I have sort of built a lot of my mortgage business around education. I'm a provider of CE classes for realtors, and I've taught hundreds of realtors different stuff, that I know. I don't know what you know. Yeah. And so do you have any education courses that you do either live or on Zoom, with people who are, more kind of like this, have questions for you by chance?
Well, that's a great question.
We should have a YouTube channel.
Yeah, we should, I guess, right? Yeah. Well, we got this, all right? So we'll just keep doing this.
This will be on YouTube, on my channel.
Yeah, exactly. So, we probably should have that, but we don't have that right now. But if you want to do those courses, reach out to me, and maybe we get enough people that are interested. We could.
I guarantee
set that up.
Yeah, I guarantee it. I can go down the track and get a course approved in a few weeks.
Yeah.
I wouldn't teach it. I'd have you teach it.
Well,
if you want to.
Yeah. Well, we could talk.
We'll talk
about
that
for sure. Yeah,
that's all fine. But
yeah. But if you have interest in that, if somebody's listening to this and hey, I'd love to hear a more detailed this, reach out to me, and we'll see if we can get enough people together to put a.
I guarantee we could. I promise we could. So we'll talk about that offline. But getting back to these, if you will, qualifying. When I qualify somebody with a traditional loan, it's income, credit, DTI, down payment, blah, blah, blah. Where does credit score, if you will, fall in your guidelines at all? Does it matter?
So we really look for like ability to repay, which kind of goes in some of those TRID laws and things that you guys have fun with on the conventional side. Ours is more common sense. So what we aren't is a private lender or a hard money lender. It gets, again, back to those wrong connotations. Like, we're not lending to somebody that just has never paid their bills, and we're the next person in line that's not going to get paid. right. And a lot of people sometimes have that connotation, like, hey, I haven't paid anybody, and now I need a loan from you, so I can't pay you. Right. That's not who we're really going after. So a common sense approach, like if you had a late payment or two on a mortgage, like where it might be a disqualifier on Fannie Freddie, it's not for us.
Right.
We've taken people out of foreclosure before because there was a justified reason. If you have 4 or 5 foreclosures, then we're probably the next guy up to get foreclosed on. That's probably not a good appetite for us. So we look at that more case by case. So back to the credit score, it's kind of 600 and above. That's kind of our threshold, but that's not a hard. Like, we look at this, we don't just look at a 680 and say it's different than a 650.
Sure.
Holistic approach. If you're maxed out on your credit cards and like, hey, that I lost my job at one of the companies. Number one, I want to try to help you find sustainability there. But two, maybe that's not the right time to go flip a house, right? Like
Right.
we want to make sure you have enough liquidity to be successful, because if we have to foreclose on it, then nobody wins.
Yeah.
Right.
It's a
So
lose-lose.
yeah. So and that kind of goes into the holistic approach versus like, hey, you have a 660 credit score or 705 FICO. Like that doesn't really change the envelope of your ability to repay. We want to see the ability for you to repay, which kind of goes into assets. And if you flip 10 houses and you have a 640 credit score, the chance of you doing the 11th one successfully is very high.
It's pretty good.
Yeah. Well,
Right.
if it's your first one, and you got enough liquidity, we can help you along the way and get you with quality tradesmen to make sure that you don't make some catastrophic mistakes. And chances are, again, pretty high. But if you're down to last couple of dollars, it just becomes like a disservice for us to lend to you.
Yeah.
Because if you can't get to the finish line, nobody wins. Like
Right.
the only way that you become successful is to get to the finish line.
Yeah. Now here's a question more on a personal level, because it just came up this week for me. I have a client who has a property in Shady Hollow, got a lot of equity,
Yep.
and wants to buy a property in Steiner area,
Okay.
and needs some cash. Would you do a bridge loan for him? Would that he's moving from the property right now? It's a homestead.
Yeah. So we can't do anything with homestead, just do some
Okay.
laws and tread
Okay.
laws, etc. But we could look at that as like a bridge loan if he had enough capacity to put 20-25% down on the new house. We generally put these in LLCs. So, there's some caveats. That's not the real design of the product. There are some circumstances where that could work if you need renovation money.
Yeah.
Where hey, you're not going to move into it before we get in there. So,
Okay. I'm really
Yeah.
just trying to get my head wrapped around all this, because this
Yeah.
is so different from what I do day to day. It's
Yeah.
kind of fun.
Yeah.
It's really kind of fun to talk to somebody who's creative and entrepreneurial and all that, because you've built a wonderful company, and I can't wait to do some business with you.
Yeah,
You
well, I
know?
appreciate it. Yeah, we'd love to do business with you too. I'm going to make a bold prediction. I know we got running out of time here. We're about 6.5 on 30-year fixed rates
Yeah,
right now.
that's right.
I think that in the next year, we're going to, if you wake up a year from today, we're going to end up about a quarter to a half a point lower than where we are today. I don't think there's going to be a huge adjustment there.
Okay.
So,
Okay. I'm still
yeah.
thinking the fives.
You thinking the fives?
That's
Okay.
what I'm thinking by
Okay.
this time next year, with a
Okay.
new Fed chairman coming on in the spring. So
I
we'll
hope you're
see.
right. Yeah.
I hope so
So,
too. But
yeah.
either way,
Yeah.
we're going to do something together.
Yeah, absolutely. Yeah,
All
I
right, buddy.
appreciate it.
We're
Yeah.
out of time.
Thank
Great
you
to
so
be
much.
with you, man.
Yeah.
It was a lot
Thank
of
you so
fun.
much.
This
Yeah.
is great.